Hello, everyone, and welcome to Urban Wealth Management's Smart Women Savvy Money February webinar. My name is Renee Norris, founder and CEO of Urban Wealth Management, where we help our clients get their financial lives in gear. Our Smart Women Savvy Money Club is focused on addressing the special needs of women with regards to their financial lives. And that's because women tend to be overlooked and underserved in the financial industry. At Urban Wealth Management, our primary focus is addressing the special needs of women, not at the exclusion of men. And here is why our service levels are so timely and important. Did you know that by the end of this decade, women will be in control of 3/4 of this country's wealth? That's yet another reason why it's so important to provide women with adequate financial services to enhance their confidence levels, knowledge base, and strengthen their financial life, and in tax planning, which we are going to talk about here. To learn more about us and our services, we really would like for you to visit our website. Well, you learn more about what our services that we provide and the people that we serve. Also, what you will see is a breakdown of our team members as well. In addition to that, you'll learn more about our Smart Women Savvy Money Club, which has been in existence for about 8 years. No cost to join, but with that service level, we provide basically consulting to provide you with lifestyle related topics that really will make an impact on your life. And what we find is that as the confidence level picks up with providing women with not just about finances, but lifestyle related things. For example, many of us are caregivers for our loved ones, our parents, cousins, etc. We talk about that and things that you need to do in order to be on that side. Your legacy planning, making sure that you have adequate estate planning opportunities to protect yourself and protect your families. So, with that said, we're going to have a very, very important topic here. And I'm so happy to introduce you to our speaker, Bella Wang, with the speech today on talk about our Smart Women Savvy Money's webinar series. Now, Bella is also part of our vested network of professionals where we have referred clients to her, and they've been so happy and so excited to work with her because she is a woman, but also so smart. She's going to cover the latest tax laws that you should all be aware of as you prepare to file your 2021 tax return. That's why this month of February is a great time. And she's going to look ahead to future changes that might be coming this year. She has extensive background. She started with wines in 2000. You only look like you're 20 years old, Bella.
I started when I was a baby.
Wow. And she has a specialization. Her practice is focusing on tax planning, consulting, and compliance for large and mid sized domestic and international businesses with high net worth individuals. And she assists clients with business entity election, tax ramifications related to mergers and acquisitions, and reorganization and planning for transactions. So, with that said, I'm going to turn it over to you, Bella. And thank you so much for taking the time because I know you got to be super busy getting prepared here for the tax season, too.
You are very, very welcome. Thank you, Renee, for that great opening and introduction. It's my great pleasure to talk to all of you again about taxes. I really love taxes. I used to have a bumper sticker on my car say, I love taxes. First of all, because I like learn new things, with tax law constantly changing, and that's why we are talking. And you always get to learn new things, and that's very challenging and motivated. And also I love tax season because you're busy, you don't have time to shop, and you get paid for overtime, so this is the best time of the year for me. But I'll definitely love to talk to you about taxes. A lot of changes, a lot of material to cover, and not just make sure you are well planned for the 2021 tax filing season, but also looking forward what you need to be aware of. So I know when Renee and I will start talking about this webinar, we were, hopefully we will have more good news on the future development in the tax law changes. Unfortunately, everything is kind of on a stop right now. So I'm just going to share what we know at this moment. I do prepare a PowerPoint presentation, so let me bring that up. So this is my PowerPoint. My topic is planning for 2020 tax filing season and what's looking forward. First, I want to quickly go over this economic impact payment, or you can call it stimulus checks, because there's a lot of confusion on what's the tax implication on those economic impact payments. There are three payments that most of taxpayers receive from the government. The first payment was sent out in mid 2020, and the second payment was sent out in early 2021, January 2021, and the third payment was sent out in mid March 2021. The first and second payment were the advance payment for your 2020 tax return. So assuming you probably account for those two payments on your 2020 return, you don't have to worry about that. For the third payment, that's an advance payment for your 2021 return. So here you will see, here's the chart, who will qualify for the third payment. And if you didn't get that third payment, which you should, you still have the opportunity to claim the credit on your 2021 returns. So let's say, because when the IRS sent out that third payment, they will use the information, your income information from the 2020 returns. And let's say if you have a big reduction, big drop in your income in 2021, and now you qualify for the payment, then like I said, you can claim the credit on your 2021 return.
So, Bella, we can't see your screen yet.
Oh, I apologize. Let me,
Share your screen.
there you go.
Yay!
Hey, finally. Let me go back one slide up so you can see this pad, the previous page. That's the page I'm talking about. There's a little chart here. So as you can see, if you are married file joint, if you're a married couple, and if your gross income, your adjusted gross income is over 160,000, then you don't qualify for the payment. But let's say if in 2020 your adjusted gross income is over 160,000, but in 2021 your payment, your income dropped below 150,000. So now you qualify for the credit, then you got to make sure that you claim the credit on your 2021 return. And if we, let's say if you are right on the borderline, so you are like, my income is $151,000. So how do I make that income to be lower so I can qualify for the payment, for the credit? There's a couple of strategies you can consider. First, if you are if you haven't make a contribution to your IRA, your individual retirement account, you can make a deductible contribution to the IRA that will reduce your adjusted gross income. If you're a self-employed person, you can establish a pension plan like a SEP IRA and some kind of qualified retirement plan. And the money you contribute to the qualified retirement plan can be tax deductible on your 2021 return. And the benefit of establish a qualified retirement plan is that you have until April 15 or actually April 18. A friendly reminder, the deadline is 18 this year, not the 15, because there's a government holiday on the 15th. So as long as you pay, you make that IRA contribution or the contribution to your retirement plan before April 18, 2022, you get a deduction on your 2021 return. If you are a small business, if you have a qualified retirement plan and you extend your return, then you get until October 15, or if you are a corporation, you have until September 15 to make that pension contribution. So that will buy you additional time to make the pension contribution, but then you get an immediate tax benefit on the deduction. And also the other tip you can use is that you make sure you claim all the above the line deduction if you are taking the standard deduction. One thing I will cover a little bit later during the presentation is that for 2021, if you are taking the standard deduction and you make some cash contribution to the qualified charity, that's above the line deduction, you get 100% deduction. So that will help you with this reducing your adjusted gross income. There's certain individual that won't qualify for the payment. If you are a non-resident alien, you don't qualify. If you are dependent of another person, like the kids, the child, or the parents, you are dependent, they won't qualify to get this economic impact payment. Then I am going to go over this child tax credit because there's some new benefit for the 2021 tax year. For the child tax credit, it increased from $2,000 to $3,000. So you got an additional $1,000 benefit for each kid. That's good. So, and if the kid is under age 6, the credit increased to $3,600. There's no earned income, or if there's no earned income, then you need to have earned income at least $2,500. And last year, starting in July 2021, the IRS started sending the advance payment to the parents. And all this is from the 2020 tax return you file with the IRS. If you have a qualifying child on your 2020 return, the IRS automatically send you this advance payment in July. It's a monthly installment. So I have 2 kids, one is 10, one is 6. And so I started getting, like last July, I started seeing, oh, there's a $600 money deposit to my bank account. I was like, wow, that's nice. I have no complaint to get that money, but I was just like, where's that money coming from? But that's the that's the advance payment from the IRS, and that's the advance payment for your 2021 credit. So let's say when you file your 2021 return, you qualify for $3,000 credit and you already got all the $3,000 from the advance payment, then there won't be any additional credit. But let's say you only got $2,000, then you get additional $1,000 credit on your 2021 return.
Wow.
Yeah, so this was a great benefit, and definitely I will wish I have a third child, and that will give me additional $3,000
Ah,
credit.
so that's addressing a question that I had. So it's not included with the standard deduction. That is separate and apart.
Yeah, so again, so when you think about tax planning, it will be helpful if you understand how your tax is calculated. Because Renee, to your point, the child tax credit is a dollar-to-dollar reduction to your liability. Is not part of your standard deduction.
Wow.
So when you calculate your tax, so basically you have to report all your income, your investment income, your income from all the 1099 you got from Renee or from the brokerage firm. So you have to report your wages, your investment income per 1099, and your other business income. So you have your gross income. That's how we talk about the adjusted gross income. So that's the total income before any deduction. Then you have some deduction, we call the above the line deduction to get to the adjusted gross income. But then you have the standard deduction or itemized deduction. You only pick one of the two, whether standard or itemized. If you don't really have a lot of itemized deduction, like your mortgage interest, the state taxes, and charitable contribution, then it's likely you're going to use the standard deduction. Standard deduction is like $24,000 for married couple. So if you are taking the standard deduction, basically you take your gross income minus your standard deduction, get to your taxable income, and then you calculate your tax based on your taxable income. Once you calculate your tax, then you claim the credit against the tax. So all the tax credit is more beneficial than your deduction, because the deduction, the tax benefit you got from the deduction, you have to take the deduction time your tax rate. So let's say if you have $10,000 deduction, your tax rate is 10%, then the true benefit is only $1,000. But the credit is a dollar-to-dollar offset of your liability. So if you get a $1,000 credit, then that's reduce your tax by $1,000. And the other benefit of this child tax credit is the fully refundable. So even though you say, oh, I just have a very bad year in 2021, I'm very hurt economically, financially, so I have a loss. I pay zero tax, but I have, kids, I have a $3,000 child tax credit, then you will get $3,000 refund check from the IRS. So like I mentioned earlier, the IRS starts sending you advance payment, and actually, so the payment you got in 2021 is 50% of the credit they estimate that you will be entitled to in 2021. So you should be able to get the remaining 50% on your 2021 return. And make sure the IRS, you should already receive the letter from the IRS to show the total amount of advanced child tax credit you receive in 2021, and whether you prepare your own return or have a tax profession to prepare your return. Make sure if you have someone else like a CPA or enrolled agent prepare your tax return, make sure that you give that letter to the preparer, because if the preparer doesn't have that information and we didn't report a correct advance payment amount on your 2021 return, then you can get a letter, a notice from the IRS, and nobody would like to get a letter or notice from the IRS.
No.
Here I just and then I just want to mention that, and I can make this PowerPoint available. So I'm just kind of quickly go over the PowerPoint, and if you want the PowerPoint, you can reach out to me or reach out to Renee, and then you can use this as a good reference material. The other thing that can benefit you if you have a dependent, whether it's a child or your parent, and if you pay somebody to take care of the child or your parent or your dependent, you qualify for this credit. And for 2021, they increased the dependent care credit from 35% to 50%. So that's a big increase. And also the qualified expenses increased from $3,000 to $8,000. So again, if you have paying somebody for taking care of your dependent, you don't want to miss this opportunity. The other, I focus a lot of time on the credit because I love to talk about credit. To me, the credit is really helping clients. Like I said, the credit is a dollar to dollar offset of your liability. So it's more powerful and more beneficial for you to claim the credit. And if you are entitled to the credit, you don't want to miss that. You don't want to leave any money on the table. The other credit is that if you're doing taking some of the classes at the college, you may qualify for this education credit. There are two different education credit. One's the American Opportunity Tax Credit, is also called Hope Credit, and one's the Lifetime Learning Credit. And this will apply not just you or your spouse. If you have children who are in college and they are your dependent, you can claim the education credit on the tuition or education related expenses you pay on their behalf. So here's a chart for comparing the two. As you can see, the Hope credit is better because it's a refundable credit. Like I said, even you pay zero tax, you can still get the refund from the government. And then there's, of course, there's an income limit. If your income exceeds certain level, then the credit will get phased out. So, and that's why it's also important for you to think about the planning. If your income is on the borderline, then you do want to think ahead on what you can do to reduce that AGI. A lot of credit, like earlier we talked about the stimulus check, the child credit or this education credit, the credit start phasing out based on your adjusted gross income, the AGI. So if you can do anything to reduce your AGI, then you should consider that ahead of time. Not wait till like January, February when you start filing your taxes, because it's probably too late. A lot of deduction, you have to make that happen before end of the year in order for you to get that deduction. So you want to do that before end of the year, like in November and December. A lot of time I tell clients, the planning is really critical, because after the year end, there's really very limited planning we can do. But in November and December, if we have some kind of projection or estimate on how much income you're gonna have, and if we know you're on the borderline, for claiming this credit, then we want to do something before the year end, so that will reduce your income and make sure that you can qualify for the credit.
Great idea. Great idea. Do you have any updates yet about the student loan debt situation?
The student loan, I know in 2021 and 2020, because the COVID, they didn't require you to make any payment on the student loan. I think that expired at end of 2021. So starting this year, you have to start, making the payment back. I know as a part, so I know there's a lot of thing happening in last 2 years. So we basically have a three large tax bill that was passed in the last 2 years. We have in March 2020, we have the CARES Act. Then in December 2020, we have the Consolidation Appropriation Act. Then in April or late March 2021, we have the American Rescue Plan Act. As a part of the CARE Act, it provide a benefit or a provision for an employer to pay the student loan on the employee's behalf. And that repayment is excludable. It's not includable in the employee's income. So I have a few clients that take advantage of that provision, but that's also expired. So far, at this point, I haven't heard anything that's going to extend that provision. But definitely, if anything change, I will let you know. And then if you're interested, we also send out, we call like a tax alert email. So if there's any new tax law changes, we always send out the email to our client, friends, or referral sources, so they can be aware of any new changes that's coming up or that's happening.
Great, thank you.
Sure. I know Renee will love this because a part of the financial advisor planning is that save money for your retirement. Again, we're talking about now it's like four people work for one person, and but with baby boomer, everybody's retiring. And then there's a labor shortage. I'm pretty sure everybody see, like we cannot find people to work for us. So make sure and take care of your own retirement. That's really important because you cannot rely on government, you cannot rely on your kids. In the old day, you can say your kids is your retirement plan, but probably not. It doesn't apply anymore. So if you are setting up some kind of retirement plan or retirement account, you can qualify for this credit. The maximum credit is $2,000. So this is called savers credit. So again, if you are considering setting up some kind of retirement account for yourself or for your business, then you don't make sure you claim the credit on your tax return. And like I said, there's also a phase out. So that's why adjusted gross income, AGI, always keep that AGI in your mind. So make sure that you watch your AGI, and if you do qualify for the credit, and make sure you keep your income under the threshold so you don't miss the opportunity. There's also, we still have this energy credit. So again, many clients, including myself, thinking about, oh, I'm gonna put a solar panel in my house. If you did spend money and put some energy efficient property in your property, then you will qualify for the credit. And there's also this electric vehicle credit, the $7,500 credit. I have a client who buy Tesla every single year because they claim the $7,500 credit every year. So he probably has like 6-7 Tesla in his garage. And every year the IRS will add some new car to their list to qualify for the credit. So make sure that you check the list, and if you buy an electric car, then you want to claim to be able to get the credit on your tax return. And this is again, this is probably just a good reference chart. Like if you have a HSA, the health saving accounts, there's how much you can contribute to the HSA each year. So again, this is a great tax tool. Again, if you are, have a high deductible, you can use the HSA to get some tax benefit. Earlier, I talked about the standard deduction. So this is for 2021, the standard deduction for married couple is 25,100, and you get an additional deduction if you are over 65. So make sure, whether, like I say, if you prepare your own return or have someone else prepare your return, make sure you putting your birthday in the software. A lot of time now, when I sign up a new client, I'll say, I need to know your birthday. And sometimes the client says, why you need to know my birthday? It's my big secret. No, because I don't want to I want to make sure I give you additional deduction if you qualify. So again, this is the elderly. If you are over 65, then you get additional $1,700 for unmarried, and this for married is a $1,350. So don't be shy. Feel free to share your birthday with your tax preparer. And then the other thing I want to bring that up, because a lot of time people not sure. I have a client who sent me like 40, 50 receipt from CVS, from the doctor, and usually it will take time to go through all the receipt, because a lot of times just, oh, I paid $20 for the prescription, I paid $30 for the lab, I paid $100 to my doctor. But just something to keep in mind, if for the medical expenses, all your qualified medical expenses, you only get a benefit if the total exceeds 7.5% of your adjusted gross income. Again, the adjusted gross income is the key. So let's say if your adjusted gross income is 100,000 in 2021, you take 100,000 times 7.5%, that's 7,500. You must have more than 7,500 of medical expenses in total in 2021 in order for you to get a benefit. So let's say your total medical expenses in 2021 is $10,000, then your deduction is only 2,500. It's whatever the total amount you paid minus that 7.5% floor. So don't think like, oh yeah, I paid $10,000 medical expenses, I get the entire deduction. Not really, only the amount in excess of your 7.5% of your AGI. So if your income is very high, you don't really have that much medical expenses, then don't bother. I guess, don't try to spend time. I have a client say, I just spent a week trying to gather all my medical receipt, and then, but end of the day, you don't get any benefit, then probably just a little bit waste of time.
So for the long-term care coverage, it still has to meet that percentage of your pay, in excess of percentage of your pay, or is that a separate tax deductible expense?
You still have to meet that percentage of pay.
Oh, okay.
So for your long-term care, it's still part of that medical expenses deduction.
Okay.
And actually, I want to mention something. Long-term care, it can be a future tax issue. In state of Washington, what I heard is that they already enact a law to require pretty much everybody has a long-term care policy. If you don't, then the employee, they're going to withhold additional payroll taxes from your paycheck. So in state of Washington, let's say you don't have a long-term care policy, and if your employee, your employer will ask whether you have a long-term care or not. If you don't, then they're going to deduct additional payroll taxes from your paycheck. I think it's still in the discussion. It's possible maybe later in the future that California is going to enact the similar legislation. If this get passed, I mean, again, just like if when you look at your paycheck from your employer, they deduct federal income tax, Social Security, Medicare, the California income tax, and state disability. If we have the similar legislation, similar requirement, then the employer can, require you to pay additional payroll taxes to California for the long-term care cost. So that's just something to keep in mind and keep your eyes on. So this is actually a big changes in California. So I'm going to just kind of talk about starting in 2018 because the last tax reform, they put a $10,000 limit on your state and local deduction. Starting in 2018, when you look at your personal tax return, the federal return, and earlier we talked about whether you take the itemized deduction or standard deduction. If you are taking itemized deduction, there are a couple big ticket items: mortgage interest, charitable contribution, all the money, cash, non-cash, you donate to your church or your charity. And then there's this state and local tax. The state and local tax include the income tax, the personal income tax you pay to California, and the property tax you pay on your house, and the DMV fee. So those are like three main things that make up the state and local tax. Before 2018, you get to deduct all. There's no limit. Starting in 2018, 1/1/2018, they put a $10,000 cap. So in California, I can tell you, if you have $1 million house, you already pay more than $10,000 in your property tax, plus the income tax you have to pay to California. You're not getting any benefit on the income tax you pay to California. So this really hurt a lot of high tax states like California and New York. So many states now, including California, and there's a total 20 states, they have, we call this workaround provision. The workaround provision is mostly, it only apply to the owner of what we call a pass-through entity. So if you are owner of an S corporation or a partnership, including LLC, then you can have the business entity make the election, pay the California income tax on your behalf, and that whole California tax payment is 100% deductible on the entity's federal return. So in other words, you will get the pass-through benefit, the tax benefit, the federal 100% federal tax benefit on this payment. It won't be subject to that $10,000 limit. So this definitely affect a lot of our clients. Many of our clients, they own an S corporation, they own an LLC. So they are taking advantage of this new California rule. And this is starting in 2021. For 2021, if you want to make that, if the entity, the business entity want to deduct that California payment they made on the owner's behalf on the 2021 federal return, that payment has to be made by before December 31st, 2021. I know we already passed that, but you can still make that payment in 2022. So S corporation partnership, their 2021 returns due on March 15, 2022. So they can still make a 2021 payment for the owner. It's just that that payment won't be deductible until next year when the entity filed the 2022 federal return, but it still will provide some benefit. There's just a week ago, California passed another legislation called SB 113, which removes some of the limitation on this the provision on the pass-through entity tax provision. So initially, when they passed this the bill 150 in July 2021, there's a tentative minimum tax limitation on the owner's ability to use the credit, but that got removed just a week ago. Again, I'm not going to spend more time on this talking about this pass-through entity, but if you are an owner of a pass-through entity, you should look into this and make sure you take advantage of this new provision. Mortgage interest, I also got a lot of questions, a lot of confusion. Again, there's a big change out of that tax reform that was passed in late 2017. So before we have the tax reform, the indebtedness limit is $1 million. You have $1 million plus 100,000 on the home equity debt. So if you have a mortgage that's less than a million when you purchase your house, and you also take out another line of credit or another home equity debt that's less than 110,000, then you get to deduct the mortgage interest you paid on those debt with no limit. That debt limitation got reduced to 750,000 if the debt was taken out after December 15, 2017. If you refinance your initial mortgage after December 15, 2017, that's fine. You can apply what's called the grandfather rule. So again, just keep in mind, if now you are selling your house, I know now it's still pretty hard to find a new home this day, because the real estate market is so hot. But if you end up buying a new property, a new principal resident, you gotta make sure you keep your mortgage balance under 750,000, because if your mortgage balance is over 750,000, then there'll be some limit on your ability to deduct that mortgage interest you paid. And you can also deduct mortgage interest you pay on the second home, but then after the 2018 the tax reform, if you have that second home equity line, the interest you pay on that is no longer deductible. The point is still deductible, and if you are paying the insurance premium, the mortgage insurance premium, that is still 100% tax deductible. Just want to quickly touch on the charitable contribution. There's a one difference in 2021 is what I mentioned earlier during my presentation. If you are taking the standard deduction and you did make some cash donation to your church or a qualified charity, then you can claim that $300 deduction as above the line deduction on your 2021 return. If you are married file joint, you get a claim up to $600. And like I said, that's above the line. So it will reduce your adjusted gross income. Retirement planning. So here's for 2021, you can contribute up to $6,000. If you're over 50, then you can contribute up to $7,000. If you haven't done that, you can still do that before April 18. So like I said, you have until April 18 to make a qualified IRA contribution for 2021. The other good tool is that, let's say you are over 72 and a half, you have the requirement minimum distribution from your IRA. You can directly transfer your distribution, your requirement minimum distribution from your IRA to a qualified charity. By doing that, that will reduce your adjusted gross income. So earlier we talked about how you can get the benefit of the credit. It all depend on your adjusted gross income. If you do the direct transfer, that will reduce your adjusted gross income, and that can qualify you for other tax benefits. If you don't do that, let's say I have a $10,000 requirement minimum distribution from my IRA. I take $10,000 out in 2021, but then I donate that $10,000 to the charity. I didn't do the direct transfer. I take the money out and then make the deduction, the charitable contribution. You may lose some benefit there because you still need to include that $10,000 distribution in your gross income. And the charitable contribution deduction is part of your itemized deduction. So if you qualify for any credit, like since your adjusted gross income exceed the threshold, you may not be able to claim the credit. But if you do the direct transfer, that will reduce your adjusted gross income. You may qualify for other benefits. The other benefit is that your Social Security benefit. So if you retire, you are getting the Social Security benefit. Up to 85% of your Social Security benefit can be taxable. It depends on your income level. But if you have the required minimum distribution from your IRA, if you do a direct transfer to the charity, that reaches your income, then it's possible that none of your Social Security benefit is taxable. So again, that's just something to keep in mind for the tax planning. So now I'm going to talk about the looking forward. What are we expecting for 2022, this tax year and forward? Like I said, unfortunately, there's this new Build Back Better. It's a very interesting name called BBB. So we have this bill that was introduced in late 2021. Unfortunately, this didn't really go too far. It got kind of just it's a limbo in the Congress. So, nobody can make decision. Nobody, the two party, the Democrat and Republican cannot come to agreement. But so we don't really have any update on this BBB. But I want to go over some of the provision in the BBB so you can kind of see what the intent is going forward. So of course, in early 2021, we have the Biden's Green Book. We call the Green Book. The Green Book has a lot of changes, proposed changes that he wants to make. One of the big things is he wants to increase the long-term capital gain tax from 20% to the maximum 27%. He's going to increase the individual tax rate, the maximum rate from 37% to 39.6%. He's going to reduce the lifetime exemption for the gift and estate tax from the 11.7 million now to 3 million or 5 million. There's a lot of stuff. And then when the Green Book was published, there's many clients coming and they all got like worried and scary. But I would say not a lot of those items in his proposal got moved forward. So now we have this Build Back Better Act that was introduced in Congress a couple of months ago. And most of the provision is only affecting big company, like Fortune 500 company or very high income earner or very wealthy people. So at least that's good. That's not affecting most of us, but I just want to quickly mention it. So in the proposal, they are going to impose a 5% surcharge if your adjusted gross income exceed 10 million. And if you're, keep in mind, this is a very high level, high threshold for individual to meet. But for trust, if you have a trust, and the trust is pay the tax itself, it's a much lower threshold for the trust. For the trust, you can see here is only 200,000. So if you have an irrevocable trust, which pay the tax itself, you gotta closely monitor, because then the trust can end up paying additional 5% surcharge tax if the income exceeds 200,000. We talk about this state and local tax. Now, we have the $10,000 limit in the BBB. They propose to increase the limit from $10,000 to $80,000. So that will be a big benefit for a lot of individual taxpayer like us. We are not a pass-through entity owner. We are just a W-2 earner. Now we don't get a benefit. If they increase the threshold, then that will give us more tax benefit. This is another big ticket item for a lot of my clients, because they are going to expand this net investment income tax, the 3.8% Medicare Obama tax, to more people, including a high wage earner. So now, like if you are an owner, so let's say you have an investment in a partnership, and a partnership own piece of real estate, or have some kind of trade or business. If you are just a passive, you're a passive investor or passive owner in this partnership, then you have to pay the 3.8% tax on the income. But if you are active, let's say you're managing the passive entity, then you don't have to pay the 3.8% tax on the entity income. But under the BBB, they're going to expand that. They say even you are active, you still have to pay the 3.8% tax on the passive income. So that's going to affect a lot of our clients if this pass through, if they pass this bill. And also there's some additional, they're going to make the excess the non-corporate loss. So now if you have a loss from a pass-through entity, a business loss that exceed 250 or 500,000, any loss above that amount is not deductible. And that's only, now that limitation is temporary and will expire after 2025, but under the BBB, they're going to make this limitation permanent. This is another big item for my client too. I will say in 2021, I see a lot of the sale happening. A lot of our clients, there's a couple of reasons. First, they are retiring, so they want to sell the business when the market is good, when they got a good offer. So they that's why they sold the business last year. Also because we still have very, very low corporate tax rate. Now the C corporate tax rate is 21%. So a lot of big company there, they have additional cash because they're not paying as much tax as before. So they have all those extra cash. They are using the cash to buy small company. The other is the interest rate is still very low. So there's only paying like 1%, 2%. So they borrow a lot of loan from the big bank, and they have all those extra cash to acquire small business. So I would say in the last 12 months, I see a lot of the merger and acquisition, a lot of M&A activity. So when you, let's say you are a small business owner, when you sell your business, and if your business is we call the C corporation, then you can qualify for this exclusion. You can exclude the capital gain up to $10 million. So let's say you you own a C corporation, it's a qualified small business. You sell it for with a $5 million capital gain. That means if you qualify all the requirement under this small business stock provision, then you don't have to pay any federal income tax on that $5 million gain. This is a big deal for a lot of my clients. And as part of this BBB proposal, they are going to remove this exclusion. So again, that's something to keep your eyes on. And I guess this is a lot of things that people are not aware of or missed it, and they probably find out when they file their taxes, and it's like, oh wow, this is a big surprise. Be careful on this wash sale rule. So again, if you sell a stock, a piece of the security, like 30 days before or after, and let's say you sell a stock, and then you buy the back either 30 days before you sell it or 30 days after you sell it. If you have a loss from the sale, that loss is not tax deductible. So I'm pretty sure that if you work with Renee and her team, they'll make sure that you don't have any issue with any limitation on this wash sale rule. So, but again, just something to keep in mind. In the BBB proposal, they put a limitation on the IRA conversion. Again, there's if your IRA is over a certain amount, or if you have any for a year beginning December 31st, 2021, it's possible you cannot roll over those IRA to the Roth IRA. But again, this is just in the proposal, doesn't mean that it will go through. This is kind of a big thing, like I mentioned earlier during the presentation. So in Biden's proposal, he's going to reduce the lifetime exemption from the now it's 12 million to 5 million. So I have a lot of clients that made a lot of gifts in 2021. Again, they want to just take advantage. So why is it important? So let's say now we have a $12 million lifetime exclusion. So when you look at your estate, let's say your total estate is, let's say 10 million. So if you made the gift, you use the entire $12 million exclusion, you don't have to pay any gift tax. You don't have, if somebody passed away, you don't have to pay any estate tax because you're still within the exemption amount. So let's say your total estate, everything you own is 10 million. You do nothing, you didn't make any gift. In 2022 or 2023, they reduced the exemption from 12 million to 5 million. Now, when you want to make a gift in 2023 or 2022, after the exemption got reduced to 5 million, let's say you still have total estate of 10 million, now the exemption is 5 million, then you have to pay gift tax or estate tax on that 5 million. So that's why I get a lot of questions. I say, why it matter? It matter because if you make the gift when the exemption amount high, then you get a full benefit. Then you don't have to pay any gift tax or estate tax. But if you wait and do nothing when the exemption amount got reduced, it's too late. Then whatever the value of your estate, the total asset you own, exceed the exemption amount, then you have to pay the gift tax and the estate tax, which can be as high as 55%. So let's say, think about now the exemption is 12 million, you have 10 million, you pay zero tax. When you get reduced to 5 million, now you have a 10 million, now you have to pay 55% estate tax or gift tax on the $5 million that you didn't give it away when, when we have the high exemption. So that's all I have today. Hopefully you will find this information is useful, helpful. Again, there's a lot of things to think about. Feel free to reach out to me if you have any question. Here you can see my contact information. So feel free to email me or call me if you want to have any further discussion on the planning.
Awesome, Bella. Fantastic, because we definitely needed to hear all of these things right now. So I appreciate all of the thoughts that you had, because I took a lot of notes myself. And I will certainly let everybody know when we send out this link to our Smart Women Savvy Money group to get a long piece of paper so you can be making notes, because you will need it. And the good news is that they can play it back over and over again to make sure that they have some understanding of that. So thank you so much for your time. And ladies, this makes you savvy. You're already smart, but this makes you savvy about handling your financial life. So cheers, fabulous. Let's get this party going.
Thank you very much, and thank you for having me. Happy
Absolutely.
taxes.